Good.
All right. So good afternoon. Again from Lewis Thomason. I'm John Lewis. Today we are actually re-recording the June 17, 2020 webinar. There's been some changes, but we're going to treat this webinar as if it took place yesterday. And if there's a significant change, we will just alert you to that fact. There was also a very good webinar today by the Boston Fed that we'll talk about in a minute. As usual, you can see this recorded webinar at our law firm link or on YouTube. And so that's where these are archived. Today's topic is the Main Street Lending Program. We'll call it part one, but it's going to be a survey or overview of Main Street lending. There are changes happening. We know they are. So if it's necessary, we'll have a part two or a subsequent webinar, maybe not next week, maybe in a couple of weeks. As you will hear in our conversation, time is of the essence because the Main Street Lending Program now sunsets September 30, 2020. After we finish that, Katie Goodner, who is going to do a lot of this Main Street lending discussion, will also update you, a quick update on the PPP Payroll Protection Program, as well as some fairly significant EIDL update. And we are going to mention a state, one state update. So having said that, let's go ahead and get started with the Main Street Lending Program. As you can see, lender registration, that is the eligible lenders, the banks for the most part, are now open for registration. The borrowers still cannot apply. They're still working on the application, although the term sheet is out, so we can see what the term sheet looks like. And as I said before, it's really not the deadline to apply, but really it's the deadline for the banks to sell the loans to the Federal Reserve subsidiary will occur on September 30 or by September 30, 2020. So that will be ostensibly the end of the program. We're going to talk today about the three different facilities or the three different programs: the Main Street New Loan, the Main Street Priority Loan, and the Main Street Expanded Loan. But we're going to really overview them. We're only going to discuss the significant differences between each facility. And for the purposes of this webinar, we're just going to discuss them in generalities. The main difference that we will look at and focus on is the difference between the Main Street Priority Program, Priority Loan Program, which does allow a more expanded refinancing scenario. And we will talk about the difference between the adjusted EBITDA multiplier requirements as we get into it. As I said, Katie Goodner will be the other primary or the only other participant from my law firm. You have seen Katie in the prior PPP discussions. She will drill down on these main differences between the programs and do a quick follow-up. All right, so let's start with the Main Street program. First, an overview of the program. The program is being run by the United States Federal Reserve System, which is a system of 14 regional Federal Reserve banks, each bank works with their regional lenders and banks that they supervise. And I'm not going to go into details about that arrangement other than to say that they're the supervisory authority in our banking system. for the purposes of this presentation anyway. The Boston Regional Federal Reserve Bank is the bank that's principally running this program. They are creating the documents. They have created the frequently asked questions, or FAQs, that we've looked at. They ran a seminar today for attorneys and others that are working on the documents for Main Street lending. So it's basically the Boston Fed that's running this program. Consequently, for those of you that want to drill down in detail, you can go to the Boston Fed website and bostonfed.com and look at documents and including the charts and slides that I'm using today, as well as the questions and answers that we're talking about today and that Katie is talking about today. So again, if you want to look in more detail, you can go to the Boston Fed website. All right, so as you can see on the chart, on the slide, here are the three different programs: the new loan program, the priority program, and the upsize program. Where they are the same is in maturity. They're all 5-year terms. Also the same is the principal deferral, which is 2 years for each. The interest deferral is the same, 1 year, and the capitalization of interest is the same. The interest rate is the same, and so, which is 300 basis points over LIBOR. We'll call it 3%. And then the principal amortization schedule, which occurs starting the third year, is the same. 15% plus interest is due those last 3 years. 15% of the balance of the loan and interest is due those last 3 years. So all those are the same in each program. Where the program differs is, if we could pull that next same slide, but we could pull up on it, where the program differs is the amounts of money, one, which is the minimum loan size, to the maximum loan size. The minimum loan size of new loan and priority loan are $250,000. The upsize tranche is $10 million. The maximum loan size for the new loan is the lesser of $35 million, or an amount that is equal to 4 times the eligible borrower's existing EBITDA, existing and adjusted EBITDA. So that adjusted EBITDA is something that Katie is going to talk about a little bit, but for now, it is an ambiguous term. It's going to be very dependent upon the individual banks that's the lender. The priority loan goes up to $50 million, and the multiplier against adjusted EBITDA there is 6 times. And the upsize tranche is $300 million, or 6 times that adjusted EBITDA. Now, the EBITDA is your 2019 EBITDA. One of the questions we have is, for whatever reason, if a borrower is making a case the trailing 12 months of either 2020 before COVID or some other period is more conducive of the loan, I don't know right now that the bank would turn that down, but we just don't have enough information about that right now. All right, the other aspects of the term of the program is dependent a lot on the part of the bank that is making the loan. And so we'll talk in a second about how the bank interfaces with the Fed, but that's really not the purpose of this conversation or this webinar. The purpose of this webinar is just to apprise you that this Main Street lending is out there and is an opportunity for you to take a look at. All right, so let's go to the comparison slide, which is the second slide. Okay, and this is just a very simple slide that I created to just, it's what we call a teaser for the borrowers, and it just explains to you with a hypothetical $1 million loan of what happens. And what happens is you make your application, you undergo the underwriting process, you get funded, and let's say on September 1, 2020, Acme Restaurant has $1 million in its restaurant bank account. So very happy day, September 1, 2020. Now let's talk about the payback to the bank. Well, for the first year, there is no payback to the bank. Year 2, you pay interest only, $30,000 plus or minus. Year 3, you begin the principal amortization and interest. Year 4, and then at the end of year 5, you pay off the balance of the loan. And presumably, you've made so much money you can do that, or you refi during that period of time. So Acme Restaurant for 2 years really has a benefit of $970,000. 2 years from now, hopefully COVID is just a bad dream. So that's the teaser on the Main Street Lending Program update. The details are different, and I know a lot of the questions are, what can we use this money for, and what about the refinancing of existing debt? What do we do about existing debt? And Katie will answer those questions. All right, well, thank you. All right, the 3 programs from this point on, I'm going to treat pretty much the same, except when we talk about refinancing, because I think the next elements I'm going to talk about are generally the same, and that is the role of the bank in all of this. So let's go to the next slide, all right? And again, this is just a very simple slide to explain Main Street lending. One, you, the customer borrower, goes to your bank. You go through the normal loan application. In fact, the specific requirements of the loan scenario by the Fed is that you use the usual and normal bank standards of the particular bank that you're dealing with. It could be your existing eligible bank. It could be a new eligible bank. But whatever their standard loan requirements, covenants are, that's what you'll go by. So could be new, if it's a different bank, could be the same. So then the bank makes the loan, you get funded, and after the bank has made the loan and has complied in the lending process with the Fed requirements, then it has the right to sell 95% of the loan to the Federal Reserve wholly owned subsidiary, which you've heard has $600 billion in which to buy these loans. Now, there's a very interesting way that this sub or SPV, special purpose vehicle, has been created. No reason to discuss that now. The real important point is, if the bank so wants, it just holds on to 5% of the loan. So of that $1 million loan that you got, the bank has got a $50,000 skin in the game. It's not that simple, but for the purposes of this slide, that's a discussion. Consequently, there are good things about that for the bank, and there's probably some bad things about that for the bank. The bad thing about the bank, if you're an existing customer, is the bank maybe has lent you a lot of money at a much higher rate. And if you refi that, they're not making as much money. Now the risk has gone down, but there's not as much money. And the question is, can they even do that? And unless they jump through certain hoops, they can't necessarily do a refi, especially in the new loan program. And as Katie will explain to you, in the priority program, they can, but there's some hurdles they have to do. And I really don't want to get into anything beyond that. I will say this about this program, this lending program: it is not a forgiveness program. It is a complicated program. It is not a scenario or program that you should do without knowing all the risks and rewards, and you need to get professional help. We're glad to do that for you, but it's a involved program. All right. So having said that, we now basically talk a little bit about your relationship and the loan application, how it's going to work. It's the same as if you were walking in to your bank or a new bank for the first time. You're going to need the same 2019 financials. You're going to be required to go through the same underwriting that you would if you were making a loan for the first time. It's a similar concept for you that have borrowed this money before. As I said, we have the term sheets, we know what the covenants are, and all those requirements, covenants, collateral and security requirements have to be negotiated with the bank, and it has to be, as I said, using normal and usual bank standards and terms. So it's not something foreign to most of you, but it is a process. The problem with the process, as Katie will point out to you, is that it does take time. So unless this program gets extended and you have a desire to look at the Main Street lending, you've got to start getting at least your own internal paperwork together now. Before I give you back to Katie, I want to emphasize one last thing, and that is that the purpose of the Main Street lending program is to preserve the businesses, your payroll, your employees. So there is the aspect that in order to prove that you need this loan and deserve this loan, you need to show the exigent circumstances that you have and why it's necessary. I don't think that's going to be hard, especially for anybody in the restaurant, especially the sit-down restaurant business. But that is an overall concept that you need to remember. And with that, Katie, unfortunately, we had hoped we would have her on video or at least have her photograph, but you're going to have her on an audio basis. So, Katie, please take over.
Thanks, John. And yes, I'm technologically struggling today, but hopefully everybody can hear me. So I'll cover quickly some of the stuff. As John highlighted, I don't want to be too repetitive, but these next couple of slides really try to boil down, here are the similarities and differences between the Main Street Lending Program facilities. As John kind of showed through the charts, your criteria for eligibility and for lenders, maturity, interest rates, the deferral periods for principal and interest, and then the ability to prepay the loans without any prepayment penalties, those are consistent across all three facilities. Where we see differences is really in what appears to be the target audience or the target borrower for these three different types of loans. And we can go to the next slide. And the way that they appear to have been structured, although some of this is speculation, is with the new loan facility meeting additional lending needs that borrowers may have. They're not looking to refinance, they're not looking to expand. This isn't a growth opportunity for them. This is just, I need additional capital. And these are smaller loans, relatively speaking, to the other two. The floor was dropped from $500,000 to $250,000 for the new loan facility and the priority loan facility back on June 8th. And for the new loan facility, the ceiling there you can see is $35 million for those loans. And determining the maximum loan amount is going to be a multiplier of 4 times the borrower's adjusted 2019 EBITDA. And we'll talk more about that adjusted EBITDA later. But the multiplier is smaller than the other two loans. And at no time during the loan existence of the loan from origination forward can that loan be contractually subordinated to any of borrower's other loans. So new loan facility, think smaller-ish loans if you consider a $35 million loan small, but targeted to be just an additional loan to a borrower's current debt portfolio. The priority loan facility is really where a lot of questions have come up. That seems to be where some borrowers are focusing because it does explicitly provide for the ability to refinance. And we'll talk about that in a second. But the floor remains the same at $250,000, but it has a $50 million ceiling, a little bit higher there. And different from the new loan facility, the maximum loan amount is determined by taking the borrower's existing and outstanding undrawn available debt, and it can exceed 6 times the borrower's 2019 adjusted EBITDA, whereas the new loan facility couldn't exceed 4 times that adjusted EBITDA. The different language, and all of this language, if anyone's interested, is drawn from the June 8th frequently asked questions that was published by the Boston Federal Reserve. This language is different, and for the priority loan facility, it's not contained in the new loan and it's not contained in the expanded loan language, but it explicitly states that while the loan must be senior to or pari passu with, in terms of priority and security, borrowers' other loans or debt instruments, other than mortgage debt, borrower may, at the time of the origination of the loan, refinance existing debt owed by the borrower to a lender that is not the eligible lender. That last little bit has opened up the door to quite a few questions. So what happens when you're wanting to work with your same bank who is also participating in the Main Street Lending Program, and you want to do a Main Street Lending facility loan, a priority loan, with your bank that holds your other debt? Well, this would seem to suggest that that's not contemplated. But as we found out through various other implementation of CARES Act programs, through the PPP, through EIDLs, a lot of times this type of language issue gets cleaned up when enough people have questions. And I know that those questions are being asked right now. And so we're continuing to monitor how that's going to end up playing out if a borrower does want to refinance loans with their same lender. If we look at the next slide, the expanded loan facility, as John mentioned earlier, is larger. This is going to be expanding current loans with a $10 million floor up to $300 million. This is not a new loan, certainly not intended to be additional debt. This is taking a current loan and expanding it, hence the name expanded loan facility. Similar to the priority loan facility, it is a 6 multiplier. When you take the borrower's existing outstanding and undrawn debt and look at 6 times borrower's adjusted 2019 EBITDA, that's going to determine the maximum loan amount. Similar to the new loan facility, it does not have that explicit language about refinancing that the priority loan facility had. However, we don't have anything explicit that says that there's not going to be a refinance. And that's another question similar to that. eligible lender question that we have with the priority loan facility that we're still hoping to get additional guidance on, to see if it is possible to do refinancing of current loans through an expanded loan facility loan. If you want to go to the next slide, Tanya. So this has been, as I mentioned and John mentioned, the refinancing question has probably been the biggest question we've seen. And as I mentioned, only the priority loan facility seems to be the only one that currently explicitly contemplates refinancing, but we're waiting on additional guidance. And you can see the difference in the language. I won't read it to you here, but these slides will be available. This is being recorded. And you can see the difference in the language between the new loan facility, the expanded loan facility, and then the language in the priority loan facility. And the FAQs in two different sections explicitly provide that the priority loan facility does contemplate refinancing. So one of the questions that had been submitted prior to the webinar was whether or not a bank had told a borrower, a potential borrower, or one of their customers, that there was no ability to refinance at all through a Main Street program. I believe that the FAQs explicitly provide otherwise. Now, they may not be able to refinance through the same bank, and that's obviously something that we're still hoping for additional guidance. But it does contemplate refinance. So at least for priority loans, potentially for expanded loan facility. We're continuing to monitor that. Let us know if you have questions. This is something that is continuing to change. While the lender application process has opened this week, the ability for borrowers to submit applications has not yet opened. John mentioned that September 30th deadline, and we are about 115 or so days from that deadline, and it's still not open to borrowers to participate. So whatever does happen when that date occurs for borrowers to participate, I would anticipate this going very quickly, and I would hope that we have some additional guidance from the Federal Reserve on some of these issues as it continues to progress. But it is important that if you're interested in these programs, that you make sure that you're staying up to date, that you're working with your advisors, with counsel, with your bankers, to find out, first of all, if your bank is going to be participating in these programs, and also, if not, finding a bank that's going to be a good fit for you. And then also looking to see which of these loans might be the best fit for your company. If we go to the next slide, this is kind of the other question that's popped up. What is the adjusted EBITDA? And unfortunately, there's no one size fits all. The language for both the new loan facility and the priority loan facility basically says that banks are going to be required to use the same methodology that they previously used for adjusting EBITDA when extending credit to either the particular borrower or similarly situated borrowers on or before April 24th, 2020. So that may be very industry specific, seeing what those adjustments are, whether they're hotels, whether they're restaurants, whether they're construction companies. And that's going to depend on how the bank has historically adjusted EBITDA in extending loans to those types of borrowers prior to this COVID crisis. So again, very borrower specific, very bank specific, and there's not going to be a magic formula that we can tell you, or anyone's going to be able to tell you exactly how that's going to play out by plugging in numbers alone. For the expanded loan facility, it's very similar language. It's just the same method for adjusting EBITDA when originating or amending the underlying loan on or before April 24th, 2020. So because that loan's already in place, what the FAQs tell us is that the bank is going to be required to use the same adjustments, the same methods for making those adjustments that they did on the underlying loan when they do the Main Street loan, the expanded loan. If you go to the next slide, Tanya. Things that we're still monitoring for Main Street lending. Eligible lender, this definition hasn't exactly been fleshed out. We do have definitions for eligible lender, but it really opens up to most lenders, most banks. The question is whether or not those banks are going to choose to participate. And I think it would be helpful, a lot of us have discussed that it would be helpful to get additional guidance on whether or not there's going to be a distinction between an eligible lender and a participating lender. Going back to the example of the priority loan facility and the ability to refinance, when it says may refinance loans not through the eligible lender, well, that may be different. What about through a non-participating lender who may be eligible, or getting into questions about that? So we may get some additional guidance there. I would like to see additional guidance on that. We also don't know what the borrower application process is going to exactly look like, although because the banks are required to use similar methodology in their underwriting as they have on loans prior to COVID, we would anticipate this also being somewhat bank specific. The September 30th, 2020 deadline that I mentioned, that has not been indicated that it will be changing anytime soon, but there's been some pressure to extend that deadline because it has taken so long for the program to be rolled out. And then, as I've mentioned, as John mentioned, this is a very borrower and bank specific determination, not just on which loan, if a loan is appropriate for you, but which of those 3 loans would be the best fit, and working with the bank, determining if the bank is the best fit, if they are an eligible and participating lender, and if you want to continue working with them. And then finally, there's been a big push from both sides of Congress, both houses of Congress, and bipartisan support to make Main Street lending program loans available to nonprofit organizations. Currently, it is not open to nonprofits. That is something that I would anticipate seeing either a decision one way or the other, but likely this being expanded in some capacity to nonprofits just based on the push that we've seen from congressional leaders. If you go to the next slide, Tanya. That gets us through Main Street lending. Really quickly, there's been some updates on the Paycheck Protection Program Flexibility Act since our last webinar last Wednesday. We've had some new interim final rules that are clarifying probably the biggest question that was out there was the loan forgiveness threshold. As those of you who watched last week or who are familiar with the PPP Flexibility Act are aware, the language was slightly different than the CARES Act and the application FAQs that were originally put out by the SBA. Under the PPP Flexibility Act, the new 60% threshold required that 60% of the total loan amount be used for payroll cost in order for forgiveness, the borrower to be eligible for forgiveness. It made it almost a cliff where if the borrower even spent 59.9%, the borrower would not be eligible for any loan forgiveness. That was not how it had originally been drafted. That was not the intent of the underlying act. And so the SBA came out and Treasury came out with new interim final rules and FAQs saying that no, this is not the case. The borrower, will continue to be eligible for partial loan forgiveness. And we've got an example here on, I believe it's the next slide, Tanya, if you want to move forward. And I've put together a formula so that borrowers can plug in and determine exactly how much of their loan will be eligible for loan forgiveness if they don't quite meet that 60% threshold. Using this $100,000 example, even if a borrower only uses $54,000 of that loan or 54%, the borrower can still receive loan forgiveness up to $90,000. It doesn't automatically eliminate the borrower's ability to get any loan forgiveness. If we go to the next slide, the other thing that has changed and I think provided some more latitude is the owner eligibility requirements. Looking at the felony, I guess what I'm going to call ineligibility threshold, on the prior PPP application, owners were required, over 20% or more were required to state if they had been convicted of a felony. or charged with or were on probation in the last 5 years. And that 5-year look-back period extended to all crimes. What the new interim final rules state is that we're only going to go back 5 years if it's a crime involving a felony involving fraud, bribery, embezzlement, or a false statement in a loan application or an application for federal assistance within the last 5 years. We're not going to go any felony. We're going to limit it to financial type crimes. And then we're going to shorten any other felony to 1 year. So that does provide some more latitude for borrowers who had non-financial felonies on their record within the last 5 years that may be outside of the past year. If we go to the next slide, this is the final kind of update that we've had in the past week. On Monday, the SBA issued press release number 2048. As some of you may remember, the EIDL program, Economic Injury Disaster Loan Program, was opened up and really expanded under the CARES Act. It was a program that predated the CARES Act. This loan program has been around through the SBA for a long time and has historically been used for disaster recovery, hurricanes, wildfires, tornadoes, things like that. On May 4th, because of the volume of loans applications that had been submitted for these EIDLs, the SBA had kind of shut it down and said, we're only going to take new applications for borrowers who are applying that are in the agricultural business, farming industry, and we're going to cap these loans at $150,000. This past Monday, the SBA said, nope, we're going to reopen it to everybody. There's been no discussion of that $150,000 cap changing, but it is now open to all industries. So if you did not get an EIDL loan submitted and you wanted to, and you were not in the agricultural or the farming industry, that is now back open for you. If we go to the next slide, what we're monitoring right now, a lot of the same things we were monitoring last week, except for some PPP changes. We're still monitoring when the Main Street Loan Lending Program will roll out for borrowers and the additional guidance that I mentioned earlier and that John talked about. We're also still waiting on some details on the PPP Flexibility Act. The Senate Democrats have requested a simpler process for small businesses to seek forgiveness, including a streamlined forgiveness application for small businesses, more guidance on safe harbor protections, those 2 additional safe harbor protections regarding an ability to rehire or to get back to the same level of business, more guidance on that, and then also just more assistance, both online and through telephonic assistance for staff being available to answer questions for business owners to make sure that they're able to submit their application correctly. We're still also waiting to find out how borrowers might be able to amend their loan documents to extend PPP loans beyond 2 years. The current PPP Flexibility Act expanded that to 5 years, but that was only for loans that took place after the enactment of the PPP Flexibility Act, but it left open the door for borrowers and banks to work together to amend their loan documents if both parties are agreeable to 5 years. The other question that I've personally had a lot from several clients is if the $100,000 annualized salary is going to be expanded to 24 weeks instead of 8, now that borrowers have the option to choose a 24-week period for their covered period. So far, that has not been addressed. We have no reason to think that that has changed, but there has been a lot of questions about that. So we will continue to monitor that to see if that amount changes. Also monitoring inability to return to the same level of business activity and exactly what standards are going to be used for those FTE calculations, how that's going to play out. I think we'll see that in the new loan forgiveness applications, or hopefully get more of that once those new loan forgiveness applications are released. And then also the same issue for alternate covered period in light of the new 24-week covered period. In the current loan forgiveness application, there is both a covered period that begins from the date that the loan was funded, or the borrower may choose an alternate covered period beginning on the first day of the next payroll period after the loan was funded. I would imagine that that's going to stay the same. But again, we'd really like to see those loan forgiveness applications to confirm. Finally, we're still monitoring the HEROES Act, the Small Business Expense Protection Act, and the Tennessee Business Relief Program details that Davidson touched on in last week's webinar for the local program here in Tennessee that was announced by Governor Lee, and that we're not quite sure yet when that's going to roll out. We're going to go to the next slide. Things that we still don't know. We still don't know what changes are going to be coming down the pike, whether that's the HEROES Act or additional stimulus measures. There's been a lot of talk, but as you all know, talk sometimes materializes in very different ways. And if you watch the news or you see what's being posted on social media or in emails that come out, there's everything from the next stimulus package may pay off your student loans to the next stimulus package may be providing travel funds for people to stimulate the tourism economy, to lots of things in between. And so we're continuing to monitor what's actually going through in legislation. We're also waiting for additional guidance on the PPP Flexibility Act, those new loan forgiveness applications, and we don't know when the Tennessee Business Relief Program will start. But we're watching all of this. We hope that you'll continue to watch for our e-blasts, that if you have questions, you'll let us know. We'll do our best to answer it based on the information that we have right now. For those of you who have watched and been paying attention to this for the past month to 2 or 3 months, for those of us that have been living it, this is an ever-changing, ever-evolving situation. So things change quickly, and we'll do our best to get that information out to you as quickly as we can. Thanks for tuning in, and we will let you know. It will probably be another couple of weeks unless something significant changes before we have another webinar. But if you have questions, please contact one of us and let us know, and we're happy to get back with you. Thanks so much.
And we're glad, just go ahead and email Katie or myself or Davidson, and we will get right back to you with an email answer. So look forward to hearing from you. Thank you, Tanya.